What if I told you there's a stock out there where retail investors are unironically screaming for a $50 price target? A stock fueled by headlines of a $1 billion AI initiative, embedded finance partnerships with major players, and what they're calling a patented weapon designed to destroy naked short sellers. Sounds like the opportunity of a lifetime, right? Well, today we're going behind the billion-dollar headlines to expose the reality of Datavault AI. This is a battleground stock right now, and the question is simple but explosive. Is this a multi-billion-dollar Web3 and AI juggernaut in the making, or is it a masterclass in retail hype hiding a ticking time bomb? Could a company trading near penny stock territory actually be sitting on the next $50 rocket, or is the crowd about to learn a painful lesson the hard way? Stick with me, because by the end of this video, you're going to see this stock in a way that 99% of retail traders never will. Before we dive in, if you enjoy no-nonsense stock breakdowns like this, do me a quick favor and hit that like button and subscribe. It genuinely helps the channel grow. Now let's get into it. To really understand what's going on here, we first have to look at the massive identity crisis happening inside this company. Because right now, Datavault AI looks like two completely different companies fighting for control of the same steering wheel. On one hand, you have the enterprise. This is the side building highly complex, zero-trust, quantum-resilient edge AI compute networks. This is serious, heavy-duty tech infrastructure, the kind of thing that could genuinely reshape an industry. But on the exact opposite side, you have the hype. This side is pumping retail engagement on stock message boards and literally distributing meme coins to shareholders. So which is the real data vault? Does DVLT want to be a serious infrastructure player that institutions take seriously? Or does it want to be a retail-driven momentum stock chasing viral moments? Can a company really be both at the same time without one side eventually collapsing the other? Well, if you look at the recent headlines, the company is leaning heavily into the narrative that gets retail traders slamming that buy button. If you spend any time on retail trading platforms like Moomoo, the sentiment right now is bordering on pure euphoria. And this hype isn't built on nothing. It's being built on a relentless barrage of buzzword-heavy press releases. We're talking about a $1 billion edge AI tokenization initiative they've branded Project Qestrel, an exclusive embedded finance partnership with Fiserv, the launch of something called a Mandela dollar stablecoin, and perhaps the most hyped catalyst of all, a United States Patent and Trademark Office patent aimed at crushing naked short sellers through tokenized dividends. The retail crowd is absolutely convinced they're winning. They believe a historic short squeeze is not just possible, but imminent. But is that belief grounded in reality, or is it a beautifully constructed illusion? Let's step back and look at the actual numbers, because the disconnect between the claims and the reality is genuinely staggering. Management is out here touting an $800 million tokenization pipeline. They're claiming an imminent, violent short squeeze is coming any day now. But what does the reality actually look like? Their actual first quarter revenue was a mere $3,400,000, and that number completely missed analyst estimates. Let that sink in for a second. An $800 million pipeline in the headlines, but only $3.4 million actually hitting the books. And that legendary short squeeze everyone's dreaming about? We're going to look at the cold, hard math on that in just a moment. And I promise you, it might shatter a whole lot of dreams. But first, we need to actually visualize the sheer scale of the promises this management team is making versus the money that's actually coming through the door. Take a good look at this. Datavault projects that the Qestrel deployment value will hit $1 billion by scaling to 1,000 sites, each with 48 GPUs per site by the end of 2026. That's the massive promise. That's the dream they're selling. Now look down here at this tiny little blip. That is their actual recognized first quarter revenue of $3.4 million. The gap between these two numbers isn't just large, it's astronomical. The current financial reality is fundamentally detached from the scale of their public relations promises. So the question becomes, how does a company bridge a gap that enormous? And more importantly, what happens if they can't? And that massive lack of recognized revenue is forcing the company to make some incredibly desperate financial decisions. Buried in a recent July 17th 8K filing, we found something genuinely alarming. To fund expenses for their upcoming NYIAX merger, Datavault took out an $833,000 bridge loan. And normally a bridge loan is no big deal. But look at these terms: a 10% original issue discount, a 13% interest rate payable in cash, and a penalty that spikes that interest all the the way up to 18% if they default. Here's the thing you need to understand. You simply do not accept payday loan-style corporate financing if your business is genuinely flush with cash from billion-dollar tech deployments. Companies swimming in cash don't sign terms like this. So what does that tell you about the real state of their balance sheet? So how does a company distract investors from a brutal balance sheet? Simple. You give them shiny objects. Management recently announced that they are distributing 50 Dream Bowl 2026 meme coins for every single share held. And on the surface, it sounds fun, right? Free coins just for holding the stock. Who wouldn't want that? But then you read the fine print and the whole thing falls apart. These coins have 0 equity rights, 0 voting rights, 0 dividend rights, and 0 monetary rights. In other words, they are worth precisely nothing in any way that actually matters. It is a strategic distraction aimed entirely at retail stock boards, completely and utterly disconnected from the underlying business. So while everyone's celebrating their free meme coins, what's actually happening behind the scenes? And while retail investors are busy collecting meme coins, the so-called smart money is making a very, very different move. While the retail crowd is aggressively buying into the short squeeze story and the Web3 juggernaut thesis, insider tracking over the last 6 months paints a genuinely grim picture. Now think about this. If the people running the company truly believed a $50 squeeze was coming, wouldn't they be buying every share they could get their hands on? So how many open market purchases were there by insiders over the last 6 months? The answer is exactly 0. Not a single one. But there were 12 separate sales. Vivasor dumped 20 million shares, and even the CEO himself, Nathaniel Bradley, unloaded over 240,000 shares. When the insiders are heading for the exits, what does that tell you about the party everyone else is celebrating? And if you think that's concerning, wait until you see what the major institutions did in the first quarter. The divergence here is absolutely stark. The big players, the ones with teams of analysts and access to information you and I could only dream of, dumped massive positions in the first quarter of 2026. State Street completely slashed its position by 85%, dumping 8.7 million shares. And Jane Street, they liquidated their entire 4.5 million share position. Gone. Every last share. These institutions are staring at the continuous equity dilution, the kind of dilution that recently caused Maxim Group to slash their price target down to just $3. And they've collectively decided to step aside. So when the smartest money in the room is quietly walking out the door, are you sure you want to be running in? But wait, what if the institutions are wrong? What about that massive short squeeze the retail crowd keeps screaming about? Could they actually be onto something the big players missed? The entire catalyst for this retail obsession is that new patent designed to expose naked shorting. And to be fair, the numbers do look juicy at first glance. As of late June, there were roughly 96.6 million shares sold short, with a days to cover ratio hovering around 5.4. That is, objectively, a massive nominal number. That's the kind of number that gets short squeeze hunters absolutely salivating. But here's the problem that nobody in those chat rooms wants to talk about: the float. Datavault has a bloated float of over 535 million shares. Think about what that means. Engineering a true, violent short squeeze against a float that enormous, from a company with a documented track record of constantly diluting its equity, is mathematically exhausting. There is simply too much supply sitting out there to absorb the buying pressure. So can a squeeze even happen when there's an ocean of shares standing in the way? And the market itself is finally starting to wake up to this reality, and we can see it clearly in the technicals. Let's look at the chart. DVLT is currently trading precariously close to its 52-week low of 25 cents, and it's a very long way from its high of $4.10. It's trapped below both its 50-day and 200-day moving averages, following a death cross earlier this year. But here's the single most telling signal of all. When they dropped that massive $1 billion Edge AI press release, the kind of headline that should have sent the stock to the moon, what actually happened? The stock didn't rocket. It actually slid 5.6%. Read that again. Their biggest, boldest announcement caused the stock to fall. That is textbook PR exhaustion. Investors are no longer buying the headlines. They are demanding recognized revenue. So when the market stops reacting to good news, what's left to hold the stock up? Now, before you write this off as a total scam and smash that sell button, we need to look at the flip side. Because despite all these red flags, DVLT is not a pure zero. They do have some tangible enterprise backing. Having IBM and Fiserv as stated partners in the edge AI sector is a legitimate foundation, and it's not nothing. Those are serious names. Furthermore, they recently changed their auditor to CBIZ, which is actually a classic structural move companies make to clean up their books before executing a merger. And here's the kicker. If that NYIAX merger closes smoothly, analysts are projecting a massive third-quarter revenue jump all the way to $45 million. So could this actually be a turnaround story hiding in plain sight? Could all these red flags just be the growing pains of a company on the verge of legitimacy? Which brings us to a fascinating realization about that terrible payday loan we talked about earlier. Let me second guess my own cynicism for just a minute here, because it's only fair. The company desperately needed capital for merger expenses. They really had only two paths available to them. Path A was to issue millions of new shares at 36 cents, which would severely dilute the retail base and crash the stock even further. Path B was to take that brutal 13% bridge loan, survive in the hyper short term, protect the retail base from dilution, and wait for the merger to unlock real capital. Now here's the twist. If they actually closed the merger, that expensive loan wasn't desperation at all. It was a brilliant, savvy survival tactic that protected shareholders from dilution. But if they fail to close it, then it's a glaring, flashing red flag. So which is it? Genius chess move or the last gasp of a sinking ship? So where does all of this leave us? Let's talk about realistic expectations. Let's throw out both of the extremes. The extreme bear thesis says this is a pure zero and a total scam, but that's unlikely given the IBM and Fiserv ties and the impending merger. On the other side, the retail bull thesis screams for a $50 squeeze and a Web3 juggernaut, but that's also unlikely because it completely ignores the cash crunch, the severe dilution, and that massive float. So the realist outlook, the one grounded in actual evidence, is that DVLT remains a highly volatile, range-bound penny stock. An immediate, realistic target would be a technical bounce to test the 50-day moving average resistance somewhere around 43 cents. Not $50, not zero. Something far more grounded in reality. But does the truth ever sell as well as the fantasy? Which brings us to the final verdict on what you should actually do with this stock. Here's the bottom line. The retail hype relies entirely on future billions, but the financial reality is constrained by million-dollar revenue misses. Despite that high short interest, the bloated 535 million share float mathematically exhausts the probability of a truly violent squeeze. The single most important fundamental milestone for this entire company is the NYIAX merger and the resulting third-quarter revenue projection. Until those signed tokenization agreements actually convert into recognized revenue on the income statement, this stock will likely struggle to break the $1 barrier. The lesson here is timeless. Don't buy the PR drops, wait for the revenue. Now, quick but important note before we wrap up. Everything you've heard in this video is for educational and informational purposes only. I am not a financial advisor, and this is not financial advice. Investing in low-priced, high-volatility stocks like this carries significant risk, and you could lose your entire investment. Always do your own thorough research and consult with a licensed financial professional before making any investment decisions. So now I want to hear from you. Here's my question. If you were forced to choose, would you bet on the NYIAX merger closing and turning DVLT into a legitimate turnaround story? Or do you think the dilution and the float will bury this stock for good? Drop your answer down in the comments below. I read every single one, and I genuinely want to know where you stand. And if this breakdown helped you cut through the noise and see the real story, please do me a favor and smash that like button. And subscribe so you never miss the next deep dive. Thanks so much for watching, and I'll see you in the next one.